Friday's economic report revealed two things. Number one, the Fed's preferred inflation gauge actually showed inflation is cooling, and this is important because the Fed sets policy based on PCE, not CPI. And now that the economy is cooling, we can expect this trend to continue, which brings the Fed closer to cutting interest rates sooner than later. We also saw something better than expected when it comes to the consumer. Now, personal spending declined, but incomes are exploding. And this suggests consumers have firepower, but they're deciding to be more conservative, preparing for the worst. And to make things worse, seasonality gives us another reason to expect the economy to decelerate. For example, tax season is a negative for the economy as consumers transfer cash to the government, which is basically sucking liquidity away from the economy. Less cash for the consumer, less spending, slower economy. So if there were to be a mini recession, it's probably going to happen somewhere between March and April. Why April? Let me explain. By the end of April, most of the tax money transferred from the consumer will be in the government spending account. And the slower the economy, the more incentivized the government is to start spending that cash, fiscal stimulus. Now, April through July is usually when the Treasury starts spending, and we can observe in both 2023 and 2024, markets rallied from April through July. So all this weakness might be painful in the short term, but it sets up lower rates and more policy intervention by the Fed and the US Treasury in the coming months. So as long as inflation continues to cool, we can expect the Fed to turn more dovish by pulling in rate cuts and watch that balance sheet because they might stop draining liquidity from the system. Now, Trump might be playing chicken with the market because Doge and tariffs are indeed slowing down the economy, but that might be what it takes to get down inflation, which allows rates to come down along with monetary and fiscal stimulus, which extends the economic cycle. Now, in the meantime, this is somewhat bullish for safe haven defensive style assets. Consumer staples, healthcare, utilities, real estate, and the weaker the economy, the more it opens up the bond trade. TLT is a long-term bond ETF, and if you're not familiar with bonds, they explode when growth slows, as long as inflation is not also rising. So why am I not worried about recession? The Fed is fully loaded with interest rate cuts and QE if needed. The White House is fully loaded with tax cuts and stimulus bills. I'm not worried about inflation because oil prices are turning lower, so any sign of disinflation should result in a face-ripping rally. If you enjoy the content, don't forget to like, subscribe, and comment. I'm actually really interested to hear what you think about the market. Stay